Hi, everyone. Want to talk to you today about risk and reward and this very important concept. Not all risk is rewarded. So, you've probably heard the saying, more risk equals more reward. And this is really the underpinning of modern portfolio theory. And the concept goes like this: if you're taking more risk in your portfolio, so higher volatility, bigger swings back and forth, bigger drawdowns, well, you should be compensated for that risk with a higher expected return. And if we look at long periods of time, if we look at major asset classes like stocks versus bonds and cash, this really tends to be true over long periods of time. There's more volatility in stocks, and investors have been compensated with a higher level of return. But what's true over long periods of time and what's true for major asset classes isn't always true for individual securities, and definitely not true over shorter periods of time. And that's what I want to talk about today. A few examples where risk was not rewarded for investors. So, to do that, I want to go back in time to May 2006 and look at two things going on in markets at the time. Number one was gold, and gold was really going up and up and up for many years preceding May 2006. And we also had the housing market on absolute fire. It was the biggest home price bubble that we ever saw in US history. So, investors very bullish on both gold and housing. Why were they bullish? Well, of course, price drives sentiment as always. And so if we look at a chart of gold, up and to the right, up 155% in the preceding 5 years. And if we look at a price of US home prices, we can see similar trend up and to the right, up over 77% in the Case Shiller 20 city index over the previous 5 years. So naturally, investors expecting continued gains from gold and housing. And if you look at Wall Street, well, Wall Street likes to satisfy investor demand. And if they see investors very bullish about a certain area of the market, well, they're going to satisfy that demand with new products. And so naturally, May 2006, two products were born: the gold miners ETF, the GDX, and the US home construction ETF, ITB. So investors looking for a way to capitalize on future price appreciation for gold and US housing market are buying these ETFs in May 2006, thinking that they're going to get a higher level of return. Now, what actually happened? Well, we got to come back to today, go back to the future, 2023. And let's start by talking about risk and volatility and compare the GDX, the ITB, to the S&P 500 and look at annualized volatility. And what we find is that much higher volatility was experienced in both the gold miners, more than double the S&P's volatility, and the home construction ETF's volatility significantly higher than the S&P 500. So that's one way to look at risk. So risk definitely higher in these two securities than just buying the U.S. market as a whole. Another way to look at risk would be to look at drawdown. So if we look at the maximum drawdowns over this time period, we can see that both home construction ETF and gold miners ETF had over 80% drawdowns during this period of time, huge drawdowns versus just 55% for the S&P 500, and that was during the financial crisis. So higher risk any way you look at it. If we're looking at volatility, we're looking at drawdowns, higher risk in these two securities. And if we come back to that original concept, well, higher risk was supposed to lead to higher reward. So as an investor, shouldn't we expect to have received a higher return in both the gold miners and home construction ETF? Well, yes, in theory, you should have. But in actuality, that did not happen. You actually saw the reverse situation where the S&P 500 had by far the highest return, over 9% per year annualized, versus 3% for the home construction ETF and a negative return for gold. And if you compound these returns over time, you're going to see a huge differential in terms of cumulative performance. S&P 500 up 345% cumulatively since May 2006 versus 74% for the home construction ETF and a negative 6% return for the gold miners. So exact opposite picture as one might expect if you're just looking at the risk profile. And the lesson, of course, is that not all risk is rewarded. This is one of many examples. You could have picked any number of other securities during this time period, would have showed you pretty much the same thing. So, what can we take away from this story? A few things. Number one, there's no guarantees in markets. It's very important for investors to understand. just because you buy a security and a risky security doesn't mean you're guaranteed any level of return, and certainly not a minimum level of return. As we could see, even over long periods of time with the gold miners, you can still have a negative return. And number two, if we're talking about risk and reward, I think this is an important concept. Yes, over long periods of time, if you're buying a major asset class, you would expect, if it's riskier, to get a higher reward than something that's much safer. But that's not true for everything. If we look at individual stocks, this is the confusing part. If we look at the big winners, we could see that Apple, Amazon, Netflix, and Google all had much higher volatility in the markets, and they all had much bigger drawdowns in the markets, and you had bigger returns. So everybody looks at these winners and says, well, therefore, if I take a big risk, I must be able to get a higher return. The two don't really work that way. Just because you take a big risk doesn't mean you're guaranteed to have a higher return, even though all of the big winners in markets had that profile, had that higher volatility. And so looking at the extreme is really important here. And if we look at stocks that have gone to zero, so things like Enron, WorldCom, Lehman Brothers, they were all at their most riskiest level right before they went to zero. So as an investor, you're buying these things a few days before they went bankrupt. There's huge volatility, huge amount of risk, and you're obviously not being rewarded for it. So number three lesson learned is diversification. And if we talk about diversification, there's a few reasons why it's important. Number one, we can't predict the future. So May 2006, everybody's bullish on gold and a housing market. And the best way to protect yourself against the unknowable future, you didn't know what gold or housing was going to do in the future, was to diversify. Number two, if you want to increase the odds that your portfolios, the risk in your portfolio will be actually rewarded, diversified portfolio with different asset classes is going to be the highest way to maximize that probability. So if you buy, of course, one individual security, that's very risky. It may work out, it may not work out. You may be compensated for that risk, or you may not be. If you buy a diversified portfolio of asset classes, much more likely over a long period of time that if you take more risk in that portfolio, you will actually be rewarded for that. So let's end it there. Thanks everyone for joining. For more content, subscribe to the channel, and we'll see you next time. Thanks.